Hey everyone, thanks for coming today. Today we're going to talk about planning for tariffs. So talk through the tariff situation, what companies are doing to plan around that, and how technology can help in the process. My name is David Grand. I'm with eCapital Advisors. I'm the delivery lead for our Adaptive Insights practice. So I help companies deliver adaptive insights, planning, budgeting, and reporting solutions. And if I can get this moving. All right, so goal of today's discussion, we only have a half an hour, so it's going to be quick, but we want to talk through how you can create a planning environment to quickly predict how tariffs will affect your business. Some of the topics we're going to go through are the current situation, impact tariffs can have on your business, how organizations are dealing with them, ways to utilize technology in the process, and then I'm going to go through a short demo of a potential tariff solution that you could build out in a technical environment to help you with the planning for tariffs. To start, I just want to go through some background. So if you've been following the news, you know that there's been several rounds of tariffs from the U.S. on foreign goods. At the same time, there's been counter tariffs on the U.S. as sort of retaliation or evening out the stakes. A lot of this has been dubbed the trade war with China, and that's the most impactful tariffs that have been put in place. But overall, the U.S. is moving from a multilateral trade agreement strategy to much more of a bilateral trade strategy agreement. So what we're seeing is an environment where we're trying to renegotiate trade deals with almost every single country that we do a lot of business with. And as part of that, it seems like tariffs are almost being used as a negotiation tactic for that. So raising tariffs, meaning that we can have leverage in any sort of trade agreement we're trying to broker between the U.S. and any given country. From a business perspective, what the impact of this ends up being is that it's very unpredictable, but it's extremely significant. So this can have massive impacts on people's cost of goods and very much change their margins of their business. Some of the products currently affected are listed here. And some of the unpredictability with this is that it's not all consistent as well. You know, some of like the raw material ones, steel, aluminum, and lumber, they started out as broad tariffs across the board, but then all of a sudden there's exemptions for certain countries. So some countries still have steel tariffs while some don't. So very unpredictable, but can have very significant impact on the business. Potential future tariffs, there have been rumors that there are potential tariffs coming against automobiles and food products out of Europe, but this is just rumors. Won't actually know anything until anything goes into place. Sometimes things are reverted at the last minute. Sometimes things come out of the blue at the last minute. Overall, this creates an environment that is just highly unstable and very hard to plan for. So some of the impacts that it can have on your business. The biggest one is pricing. We've talked to a client who had a giant contract in place for building material to provide building materials for a large project. The contract was at a fixed price per unit, and with the new tariffs coming in, all of a sudden their material costs went through the roof, and they actually had to cancel that contract. Fulfilling the contract just would have cost more to the company than the penalties they, ended up receiving by canceling that contract. So this is having significant impact, and it should be changing everyone's pricing for any materials that are coming from a country that now has tariffs on it, but as well as supply and inventory issues as well. We talked to another one of our customers who is a retailer, and they had a large shipment coming into the U.S., and it got held up in customs for much longer than they expected. This is due to some of the changing rules and slow process to get everything implemented, but they ended up with huge inventory issues because their product was held and they weren't able to distribute that throughout the country. So as most manufacturers know, you generally run at a pretty low level of inventory because inventory is expensive to hold, so they were not prepared for this, and it ended up causing issues at their stores where they weren't able to deliver product. Shrinking margins is obviously an issue, but for the most part, it's how long are these margins going to be small, and what's the impact of that going to be on the rest of our business? So is this something we're going to have to deal with for 3 months? Are we going to have to deal with this for a year? What are the other impacts we're going to have to make to our business to deal with the fact that we're not making as much per unit as we were in the past? And what if that flips back at some point in the future? Those are the sort of impacts it can have on an organization. Reduced sales in foreign markets. So with counter tariffs going into place, a lot of companies are sort of being targeted or singled out as they're selling their products in foreign markets. For instance, again, a lot of this is rumor until anything happens, but there's been rumors that China is thinking of banning all of Apple's products. That's going to have a huge impact, obviously, on Apple, but a lot of other stores as well, or a lot of other companies as well. So anybody who sells accessories for MacBooks or iPhones or anything like that, all of a sudden their sales numbers are hugely affected by the fact that they've just lost the entire China market. But there could also be opportunities as well. So, for instance, in that same case, Google sells Pixel phones out of the U.S. If their products aren't banned, all of a sudden their market share in China can go up. So they need to be planning for the fact that, hey, our sales numbers can probably increase. They need to be figuring out by how much and make sure they're ready for that in case something happens. This is also affecting a lot of companies, especially agriculture. For instance, Cargill just posted a 41% drop in their Q4 revenue, and they're attributing most of that to the fact that tariffs in China have reduced the amount they've been able to sell in that market. So this is having impacts on businesses all across the board, or anyone that's doing international business. So how are organizations dealing with tariffs? For the most part, companies are creating a task force, or what we generally call a war room, where you're taking a lot of the top analysts from your company and you're making it their full-time job to deal with tariffs, essentially. So putting them in a room and having them figure out what is the impact that this is going to have on our pricing, on our margins, on our volume changes. And a lot of that also comes back to what's the current situation of tariffs and what's the likelihood of new tariffs, or what's the likely duration of the current tariffs. So figuring out the political environment and the impact it has on the business, as well as what are options available to us. So are there levers we can pull to help increase our profitability or best deal with this? So can we change our prices? Are there ways we can find new suppliers in different areas? So can we find domestic suppliers where they won't have tariffs as products bought from them? Or do we need to cancel projects like the example we mentioned before? Either external ones, or do we need to cancel internal projects because we need to hold on to cash for now to try to weather through the tariffs? Do things need to be scaled back? Do we have too many people for the current margins we're running on? Or are there opportunities where we need to ramp things up, where we think we can sell more in a specific environment? So do we need more salespeople in that environment to try to push product? And do we need to worry about our supply chain to make sure that it's going to match the sales volume with a given opportunity? That's how companies are dealing with it. And essentially what it is it's a lot of different scenarios. So how can technology help? Well, when you're running all these different scenarios, oftentimes you're doing it in Excel. So you end up with just hundreds, if not thousands, of workbooks of what happens if we do this scenario and what's the risk on this? And then you end up doing all these comparisons back or linking all these Excel sheets together to say, well, what about that one situation we had? Or what about a slight variation on that one situation? So you end up with these shared drives with just thousands of workbooks as you're trying to figure out how are we going to deal with this tariff situation. So how technology can help. You can build a model where you have detailed product costs, and things are then just pulling levers and seeing what comes out the other side. So if you have a detailed product cost where you're including raw materials and you're potentially modeling on source locations. So for instance, if you need steel, you can have a model that says, here's the cost of steel from these 5 vendors, and here's how much I'm going to purchase from each of them, or here's a percentage profile of what I want to purchase from each of them. Models like that allow ease of change to see if I change all of this from this vendor to this vendor, what happens to our income statement. It's models like that that really allow for a lot of these what-if scenarios to help you as you're assessing these impacts. You need location-based sales modules as well. Most people, when they do any sort of sales modules, have location in there, but sometimes not. Sometimes people just plan an overall number or a product or a number by product. That's going to be a mistake if you think sales can change based on region. That's something you should be planning by the different locations. Next two are kind of connected. So you're going to want a driver-based revenue model, and overall you need a driver-based revenue model that's connected to volume, it's connected to revenue, and it's connected to cost of goods sold. What you want to be doing is be able to make one change and see it flow through the entire model. So if my volume goes up, I need to see the impact to revenue, and I need to be able to see the impact to cost of goods sold. That's something that should be table stakes for any system. You shouldn't have to go through and run a manual calculation to figure out what is the gross margin just because I changed my volume. And then I think the most important part is the what-if scenario modeling. We talked about it before. You end up with hundreds, if not thousands, of different scenarios where I want to see what the impact is if we, change one of our suppliers. So if we change a supplier to someone in the U.S., it's going to cost more overall per product, but there'll be no tariff on it. So what happens if they force us to sign a 12-year contract? That's one situation. What if they force us to sign a 12-year contract and the tariffs get cut out in 3 months? That's a different situation, but I want to compare that against what happens if we stick with our current supplier based abroad, but the tariffs go away in 3 months. That's 3 easy situations you want to figure out right away, and you probably want to do that at 3, 6, 9, 12 months. And you probably want to assign a probability to them as well, so you can figure out what is the most expected outcome and what's our best option for dealing with that. So having a system that can save all of those, easily access all of those, run comparisons against one of those is very important as you're looking at how to model different situations. And part of this goes with a rolling forecast as well. If you're doing what-if scenario modeling, you probably want to be from a situation where here's my expected outcome, or here's everything we know today, or here's our forecast with everything we know today. So current tariffs, current sales volumes, here's what we have. That gives you the best starting point as you're working on a what-if model to figure out what could change, what should change, how should we be dealing with these sorts of tariffs impacting our business. And then how do we hedge this? So that's where the risk and expected profile comes in to say, okay, what's the most likely situation, or, out of here's the levers we pull. If we pull this lever, what are the outcomes if any of these 5 situations happen, or what's most expected to happen? Now I want to show you guys a demo of a tool called Adaptive Insights. And it's an interconnected planning, analysis, reporting, and modeling tool. So you're able to model things like tariffs on your products and instantly see the reporting on it or the dashboard on it and drill in and do the analysis. So we're going to start by going into, we're already in a what-if scenario. So you can see we have this base forecast. I copied that into what if 1 so we can make some changes and see the impact and compare versus base forecast to see what changes because of tariffs. So in this scenario, we've got multiple different forms. We'll say we are an electronics manufacturer that buys components, manufactures them together, and then sells them to the market. So we've got some product revenue and we've got some service revenue as we're helping companies implement those electronics as well. Most of these are formula driven. Anywhere you see a little purple arrow means that our product revenue is coming from a different form or a different calculation. You can see here we've got the whole income statement, revenue, cost of goods sold, margin all the way down to EBITDA. We've got our taxes, interest, and net income. Underneath this, we've got a specific product revenue sheet where we can see by product what are our units, price, discount, all the way down to gross margin and gross margin percentage. And you'll notice here product A is at about 5%, 4% throughout the year. And we have another sheet where we actually look at the individual product pricing, cost, and what I built in here is something that you should think about doing is a tariff amount per unit. So here I've got source country as a attribute on the product, but this can be much more detailed. Like I mentioned before, if you know which raw material, you can have a model that builds out, this product uses steel and it uses a little bit of aluminum and these other different components that I have to buy from different factories. And you can have the source based on that location. For this one, I'm going to keep it simple, and what I'm going to do is I'm just going to apply tariffs to based on country. So let's say we want to model a situation where we're going to have a 10% tariff on Canada, 25% on China, and a 10% tariff on Mexico. I can hit save. In a tool like this, everything calculates automatically, so I don't need to go in and run a process. I don't need to re-aggregate numbers. Everything just calculates and shows up right away. We can see all of a sudden our average margin is going to go negative as soon as we make those tariff changes. So we can come back to this product revenue sheet and see that for product A, which we saw was coming out of China, now all of a sudden our average margin is 21%, negative 21% on the year. Well, that's tough to deal with. We can't be selling product at a negative margin, so that's a huge issue. Overall, we can check what the impact is on our entire business and see that our overall margin is still about 20%. Well, you might be thinking, okay, but what was it before? So what you can do is you can have reports to do version comparisons. We were looking at the base forecast before, now we're looking at what if one. So what's the variance? What's the variance percentage? You can see the biggest change was cost of goods sold, and that led to a 8% change in the gross margin on the year, but not much else changed on the top of the income statement. Product revenue didn't change because we didn't make any volume changes. Our operating expenses didn't change, and then we see the impact flow down to the bottom to EBITDA, and then EBITDA is obviously connected to taxes, so we had a small decrease in taxes as well. But overall, it's a 38% impact on net income. That's a massive change for some tariffs like that coming in. So with a report like this, you can build in all those versions and have them as drop-downs to just compare any two you want, or put risk profiles in there to say what is the expected outcome by adding these two together, or something like that. And then back in something like dashboards, you can, this is the before state, I can hit refresh, and we'll see this comparison of what is our product profitability. The blue is this what if scenario, or it's fed from up here, and the red is that base forecast. So you can see a couple products didn't change, but some of them had a big difference because we added this tariff in, and some of them even went negative. You can have waterfalls in here as well to say, okay, here's the original number we had. Well, here's where the differences came in versus what we have in our what if scenario. So these products are the ones that built that change in our gross margin. So with a tool like that, you can really model in any given way. And in this brief example, we talked through just doing a product tariff amount by unit. You could also have, by country, build out a form that's showing all the different countries, and it links over to something like this. And this could be a read-only to just say, this is coming from anywhere where the tariff is, or the product's coming from Canada, it's going to have a 10% tariff on it. So that's all we had for today. Does anybody have any questions? If you guys have any questions, feel free to just type them into the Q&A box on the bottom. We'll give you guys a minute to type them in. All right, we got one here. Looks like you mentioned a company you work with had a supply issue where the product was delayed in customs. How long was the inventory held up, and what was the impact? So overall, what I heard was the product was held up for about 6 weeks, and they had a buffer of about a month based on current inventory levels. So they had to readjust their inventory that they had as soon as they heard that there was potentially a delay. So essentially what they did is they decided, from their distribution centers, here's the stores we're going to focus on where we think it will have the least amount of impact if we, or essentially decide which stores will have the least amount of impact on if they run out of stock. Because they did run out of stock at some of the stores, but they wanted to make sure that some of their high volume stores weren't going to run out because they wanted to minimize the impact. But essentially it was about 6 weeks of unexpected delays that they got because the product was held up in customs. All right, looks like that's it for questions. Well, thank you guys all for attending. We'll send out a recap of this in the next day or so, and you'll be able to find this on our website. Thanks again, everyone.